Hey everyone, welcome back to the channel, your number one source for income-oriented investing. And Hamilton ETFs has announced 4 brand new ETFs that are scheduled to launch near the end of January, everyone. So let's review these ETFs together because the web pages are up here. So we'll have a great idea of what these ETFs are all about. So you got 4 of them. You have CMVP, which is the Canadian Dividend Champions ETF. You have SMVP, the US Dividend Champions. So right away, that tells me that obviously these ETFs are going to be not only dividend focused, but really quality dividend focused, as we'll see in a second here. Just like the headline says, right? Low cost dividend growth. So when you hear that term dividend growth, it means not only dividend stocks or stocks that give consistent dividend, but that actually grow their dividend over time. And then there's also CWIN and SWIN, which are basically 125% exposure to the corresponding ETF. So CWIN is basically CMVP with 25% leverage. SWIN is basically SMVP with 25% leverage. So got to look at the original ETFs here, the ones without the leverage, to get a feel for what they have and what they're all about. So just like the highlights say here, Hamilton ETFs, always great information, great web pages. Equal weight portfolio of blue chip Canadian companies with a long history of rising dividends. Also, 0% management fee. So this is a promotion till January 31st of 2026. So pretty much a year with no management fee. And after that, it's going to 19 basis points. So very low management fee, 0 right now. It's going to be promotional when it launches, and then it's going to return to 0.19 in January 31st, 2026. So that's pretty cool. So you have index outperformance versus the TSX 60 with lower volatility. We know that the TSX 60, top 60 companies in Canada. It's basically the S&P 500 of Canada, if you will. So for who is this ETF for? Well, for people who want low cost exposure to Canadian dividend growing companies, tax efficiency from Canadian eligible dividends. Of course, if you have a portfolio of pretty much Canadian dividend stocks, most of the income generated, if not all of it, is going to be Canadian eligible dividends, which is very tax efficient, especially in low tax brackets. Lower volatility. We know that dividend stocks typically has lower volatility than the overall market because they're less sold, right? There's less action on them because they're more stable, so there's less people selling them off, for example, with the potential of long-term outperformance of the TSX 60. So you actually see here they created an index called the Selective Canada Dividend Elite Champions Index, which is basically going to replicate the ETF, replicate the strategy. And they've actually compared it to the TSX 60 index for more than 10 years, since 2006, I believe. And you see that the index is outperforming the TSX 60. This doesn't surprise me because there's quite a few Canadian ETFs that only focus on dividend stocks, and they typically beat the TSX 60. I'll discuss some popular ones later on in the video here, but just to give you an idea here of the index. And by the way, if you scroll all the way down, there's actually a link to the index itself. So if you want to do more research on the index, you could go in documents, and there's a lot more details on the index itself. But of course, let's go through, before we look at the grids at the top, I want to see what kind of stocks, what kind of sector allocation there is, because that's obviously always the most important thing, guys. When you're investing in ETFs, you got to look at the stocks inside. So the breakdown or the sector allocation looks very typically Canadian, right? Very high in financials and energy, which is what the Canadian market and economy focuses on. But there's consumer staples as well, which I'm assuming is going to have things like Loblaws and grocery stores. So let's just take a look at the stocks together here. So none of these names are really going to surprise you. We should all know a lot of them. Here's Loblaws. You got, of course, a lot of financials, right? The banks are going to be there. Here's Couche-Tard. Here's TC Energy, Enbridge, and pipelines. Even some materials, some gold miners as well, more banks, Waste Connections, utilities, some energy, of course, Canadian CP, right, the railroad. So it's really what you would expect it's pretty much Canadian dividend stocks, blue chip, quality, solid companies that grow their dividend over time. So this is what they're looking at. So if we look at the characteristics of the index or the stock selection here, established companies with an average market cap of 73 billion. So big companies, 10% plus portfolio average annual dividend growth. So on average, the portfolio stocks, they grow their dividend over time. Stability, companies with 6+ years of increasing dividends and no decreases, right? So if we look at what kind of yield, we already saw the potential return compared to the TSX 60. It's a little bit higher here, just like the graph shows. If we look at the potential yield, the TSX 60, which has a lot of dividend stocks, not all of them are dividend stocks, but if this index obviously is only dividend stocks, it's going to have a little bit more yield than the TSX 60, approximately 3.6%. So I'm assuming that's the yield approximately that we could expect from this ETF. Of course, it's going to have lower volatility versus the overall market when you're just choosing the dividend stocks. That's typically the case. There's a couple of other interesting metrics as well. So we have the stocks, we have the indicative sector allocation. Remember, this ETF is not out yet. It's not launched yet. Everyone, you have the potential stocks as well as the percentages here as well. Rebalance quarterly, right? When you have equal weight, they typically rebalance quarterly here. Monthly distributions, which is nice. And again, the 0% management fee till the promotional period is over, and then it goes to 0.19, which is pretty much in line with some of its competition, which we're going to take a look at in a second here. So if we look at CWIN, so CWIN is basically will hold. If we just scroll right down to the holdings, it's going to have 125% exposure to CMVP, right? So it's basically CMVP with 25% leverage. So what can we expect with 25% leverage? 25% more volatility, of course, but most likely better performance over the long run if the index keeps going up over the long run. And I absolutely love this chart. You actually see the comparison of the indexes here, the TSX 60 versus the one without the leverage, which we just saw on the other page. But check out the one with the leverage here. So obviously you could see that adding that 25% leverage over time could definitely increase performance. And remember, everyone, this is leverage that Hamilton ETFs is taking, that's managing. So you're not going to get margin called by holding this ETF. This is all very modest leverage, which they get at much better interest rates than me and you can, right? Because they're a big institution now with over $7 billion in AUM. One thing to note, the management fee, there is no discount on the leverage version. It's 65 basis points. So it's a little bit higher than the one without the leverage. But you guys know, me personally, I would always take the leverage option. But that's just me. That's just my opinion. It's really up to you which one you choose. I do have to admit that, the 0% fee for a year, for almost a year or whatever, is a really good deal. But this one is still 65 basis points here, so in line with the other leveraged non-covered call ETFs from Hamilton, right? Like HCAL and HFIN. So that's basically it. And obviously with 25% more leverage, everyone, we could expect a little bit more yield, right? Approximately, let's say 25% more yield. So you'll probably be in the 4.1, 4.2% range. Of course, this is just an estimate as the ETF didn't come out. And by the way, the starting price for all four of these ETFs, I believe, is going to be $16. And they already announced their first estimated monthly distribution, which is going to be paid out in March. So it's going to be declared at the end of February, paid out in March, the first one. But again, remember, this is just an estimate. And if we look at the CWIN one, the one with the leverage, right, it's slightly higher. So, you guys could calculate the potential or approximate yield based on a $16 starting price based on this first monthly distribution, if you guys want. So one thing I forgot to mention here is that the Canadian one, CMVP, looks like it's going to be a set number of stocks, 25 stocks. That's going to be the universe. Maybe it'll have more, maybe it'll have less at certain times, but the goal is to have approximately 25 blue chip Canadian dividend growers here. And basically, Hamilton advised me that if, for example, one of these companies cuts their dividend or stops growing their dividend, they have plenty of other stocks to replace it with. Now they're not gonna just kick a stock out right away if they stop growing their dividend or if they reduce it, but it is something that they look at closely. They really want to make sure that this index is focused on dividend growth stocks as well. So more on that selection. You could read more about that if you look at the index, right? How the index works. But it's really, they're trying to keep 25 dividend growth companies in here. So if one of them does cut their dividend, you could probably expect at a certain time that they'll replace it with another blue chip, dividend stock that is growing their dividend over time. And they did tell me that there's plenty of stocks to choose from, more than definitely 25 that fit that criteria. So moving on to the US one, SMVP, it's basically very, very similar concept, everyone. The management fee is the same as well. The discount is the same. Even on the leverage one, it's 125% exposure to the non-leveraged one. Based on, there's another index that it's based on, which is very similar stock selection criteria. This is, again, US dividend growers. The biggest difference is it has a little bit more stocks in here. It has 35 stocks instead of 25. So obviously the universe of dividend growth, quality growth stocks is much bigger in the US. So it's 35 stocks here. And you could scroll through the names. You'll recognize a lot of them. And if we look at the sector allocation breakdown, you could see how, there's not much tech. There's healthcare, there's financials, lots of industrials and consumer staples. So there's a bit of real estate, there's a bit of utilities, there's a bit of energy and materials. So as we know, a lot of tech companies don't have dividends. So this is more really, you could say, more value type stocks, right? Stocks that have a dividend. So this could be a good complement maybe to an S&P 500 holding, for example, if you want more value stocks. But again, this is going to focus again on dividend stocks, pure dividend stocks that have quality, that grow their dividends over time. Same management fee, same type of deal. Here's the comparison of the index versus the S&P 500. You see that it's pretty much in line with the S&P 500. If we look at the leveraged one, obviously, 25% leverage could have potential for increased performance over time, just like you can see here, the gold. That's the leveraged one, basically, compared to the non-leveraged one and the S&P 500. So the US one, again, has a little bit more stocks. It's also one thing to note, 100% hedge the Canadian dollar. Also monthly distributions. And if we look at the potential yield, a little bit lower at 2.3 versus the Canadian one, but still much higher, obviously, than the S&P 500. We know that the US market, there's less dividend stock concentration than on the Canadian market, but still 2.3% type of yield here. And of course, you'll have a bit lower volatility than just holding the S&P 500, et cetera, et cetera. So obviously with the leverage one, we could expect a little bit more, 25% approximately more. And the first distributions were also announced, and I believe they're also going to be with $16 starting prices. So you'll be able to figure out approximately the yield, everyone, as well. So what could we compare these ETFs to? Well, let's compare the Canadian one, CMVP, to VDY. I think it's a good comparison. VDY is the Vanguard FTSE Canadian High Dividend Yield Index ETF. It's one of the biggest, most popular, and best performing Canadian dividend stock ETF. So, and by the way, the MER is 22 basis points. That's the approximate MER is going to be about that. For CMVP as well. So very, very similar management fees. The yield's a little bit higher on this one because this one is really selecting the high dividend stocks. But one major difference that I did find is that VDY is extremely concentrated only in two sectors, financials and energy. You see 58%, almost 60% of this ETF is in financial stocks, 28.94. So almost almost 90% of VDY is focused on financials and energy. So you definitely have a lot more diversification, I would say, with this one in terms of a sector, right? It's obviously still heavy in financials, but much more balanced, in my opinion, here in terms of sector allocation. And Hamilton was kind enough to give me the performance comparison of the index of the ETF, Canadian Hamilton Champions Index, versus the index that the VDY ETF uses, which is the FTSE Canada High Dividend Yield Total Return Index. And you could see the performance of over 10 years that the Canadian Dividend Elite Champions Index is outperforming it. So that's good news. So this could give you potential data of how it could perform over time versus VDY, which is very, very, very popular. But CWIN, in my opinion, you could get approximately the same yield, because it has 25% leverage, approximately the same yield as VDY. So I think, if you hold VDY, CWIN, it definitely would be one that I personally would consider. And this is really a game changer because this is really the first, I believe, dividend ETF in Canada that has no covered calls or anything. By the way, no covered calls. I confirm there will be no covered call running on any of these ETFs, on any of these stocks. It's not a covered call strategy. It's a dividend growth strategy. But CWIN and SWIN, first of their kind, because you actually get a little bit of leverage now, 25% leverage on a group of dividend growth stocks. So it's really a first of its kind. So if you really like these types of ETFs, VDY or XDV is another one. CDZ is another one. And I believe I have the performance versus XDV as well. You see the performance here. So thank you to Hamilton for providing these charts. So very interesting options here if you're a dividend investor, you really like those dividend stocks. Well, these two could be a really good fit if you want that Canadian dividend stock exposure. CWIN is particularly interesting in my opinion. If I was, for example, a dividend investor, CWIN is what I would be gravitating towards, because you guys know I personally love adding a little bit of leverage, hands off, and of course it boosts your yield too, to give you the same type of yield as VDY, potentially more performance over time as well. And for the US ones, SMVP, I think the one we could compare it to is really VGH. This is the Canadian hedged ETF version of VGG. So there's VGG, VGH. We'll compare it to VGH because SMVP is Canadian currency hedged. So if we look at the performance, this we already saw. The performance versus VGH, you could see also some potential. The index has outperformed in the last 15 years or so. So yeah, very interesting stuff, guys. Brand new ETFs to really consider if you're a dividend investor. So in my opinion, for who are these ETFs designed for? If you're a dividend lover, if you want dividend stocks, whether it's Canadian or US. So remember that CMVP and CWIN, the majority of the income, if not all of it, is going to be Canadian eligible dividends. So if you're in a low tax bracket, this could be really great for a taxable account, for your regular cash account. But remember, for the US ones, most of the dividends, all of the dividends from the US is considered foreign income. So if you want this one, this might be better in a TFSA or an RSP, right? A registered account. It might be a little more tax efficient in there. But if you're a dividend investor, if you don't want to pick and choose your own dividend stocks, you want quality dividend stocks, you want dividend stocks that grow their dividends over time. And of course, we could expect that the income and the yield also grows over time, right? If these dividend stocks are continuously increasing their dividend, these are really the ETFs for you. SMVP could be a great fit if you want to balance out your S&P 500, NASDAQ 100 exposure, which is really geared towards tech and more growth companies. Adding a little bit of this to balance it out could be a great idea. And myself personally, I really like the leverage versions. If you're a long-term investor, I would always go for the leverage version. So CWIN for the Canadian dividend stocks, SWIN for the US dividend stock. So give me a thumbs up. I would really appreciate it. Let me know if you have any further questions about anything here. And if I have a lot of questions, maybe we could interview the guys at Hamilton ETFs to answer those questions. They're always more than happy to come on the channel. So appreciate you watching, everyone, and see you next time.